Welcome to the On the Tape podcast. Guy Adami, always joined by Dan Nathan and Danny Moses. On today's On the Tape podcast, President Biden and President Xi met. Apparently, it was a very nice meeting, and a lot of good things came out of it.
Pandas.
Pardon me?
We got pandas.
Pandas.
Yeah.
Yes, pandas. And I guess sort of some of the rhetoric has been ratcheted down. That's a good thing. Stock market. And what do they say? En fuego?
Yeah, on fire.
It's a good thing, right?
Yeah.
Microsoft making all-time highs. We have, obviously, NVIDIA next week. Jobless claims. The unemployment rate is ticking up.
Yeah.
So we have all these cross currents, Danny Moses. But as I mentioned, we were in Florida this week. And by the way, stick around because we have a great conversation with Terry Duffy. He's the CEO of CME Group. We're going to talk about a lot of things with him, including their relationship with St. Jude's Children's Hospital. They raised a lot of money. We donated. I encourage our listeners and viewers to do the same. Terry Duffy, Danny, is friends with great Michael Jordan. And as Danny knows, the walk-up music, the intro music for those great Bulls teams, I believe, was a song called Sirius from the Alan Parsons Project.
Correct.
Danny, you're familiar with that. Is that correct?
I am.
And it's odd because when Dan and I got off the plane earlier today, we got into, what do they call those things that you call for?
An Uber.
Yeah, and we got in an Uber. And in the 1981 song, Games People Play, from the Alan Parsons Project, Danny, was playing. I sat my ass in the seat, and next thing I know, I hear the lyrics, and I'm not going to do it because you do it much better. So, Danny, help me out with a little Games People Play.
Where do we go from here now that all of the stocks have gone up? And how do we spend our time knowing that nobody gives us a damn? That one.
Well,
I just changed the word to stocks, right? So,
and think about the games people play, because this week the games that people were playing came in the form of CPI, Danny, which came in 0.1% softer than expected. But one of the games that apparently was being played, healthcare insurance costs, which is a component of said CPI, was down 35% year over year. So, Dan, as I mentioned the other day, what I did, because I'm a smart person, I'm a business person, I see this and I said, wow. So I called up my healthcare insurance provider and said, hey, Guy Adami here, I see that rates are down 35% year over year. Give me my rebate. And they click. So Danny Moses, again, people are going to say, Guy, sour grapes, you're just dogmatic, blah. You're looking for you're looking for love in all the wrong places. Not that that's a song we want to go down. But help me out here.
All right. So what the cool thing about Walmart and Target and some of these retailers is you kind of get a live look mid-quarter almost, right? Because they're an October ending quarter. So you kind of get that backdrop a little bit. So when you get this data that comes out on CPI, PPI, retail sales, and all the stuff that comes out, was telling you that inflation was slowing. And we've said that if inflation slows, is that good for retailers? Because that means that, the pricing might come in over time, right? So you got a live look. So let's start with the live look today from Walmart and Target yesterday and Williams and Sonoma, what they're telling us. The retailers that are up, and I don't know how long they're going to stay up, Macy's, Williams, Sonoma, Target, are up because of inventory management. Good on them. They've been targeting that a long time. They bought less, right? They held prices on certain things, right? Stop the lower discounting that was going on, and they, make money. Okay, fine. But at some point, you got to rebuy that inventory or you're not going to make up sales. And they all pretty much guided to lower sales and said that the consumer wasn't in great shape. Walmart, which still had a decent quarter, said towards the end of their quarter, during the month of October, they saw the consumer weakening, right? And they're concerned and going this quarter, that's what's happening. We got confirmation of that, I think, with the retail sales number that we just got for October. And also, again, PPI. Let me make one other comment. Over in the UK, inflation was also down lower than expected. Down 4.6% is their CPI now. So 4.6% is still very high. The FTSE rallied to be up on the year at this point. So people were geared up to look at this. And before we go to Dan on this, I just want to point this out because this is extraordinary to me. In the Fed funds futures curve, we are now in the March meeting, which is March 20th, a 35% chance of a cut. That's up from 12% just a week ago. And in the May meeting, which is May 1st, a 69% cut. That was 35. And in the June meeting, 50% chance that we've experienced 2 cuts by then. So effectively what we've done is excited investors by bringing forward, we talked about this, bringing forward this rate cut, but at the same time, continuous claims, jobless claims, everything is pointing to economy slowing. And you mentioned, Guy, China, kind of like standing ovation yesterday in San Francisco from all the suck up CEOs who were in there giving, okay, great. Okay. Seemed okay. They were at peace for a day or two. But again, I go back to what does this mean? And I think that a slowing inflation comes in conjunction with slower goods purchases.
Yeah, and slowing inflation, even with a 3.2% CPI, means very high inflation year over year at a time where the economy here in the U.S. is slowing. I know we're going to talk a little bit about President Biden, President Xi's visit here. I mean, President Xi, it seemed like we got a lot more out of this visit on our home soil than President Xi did. And we know that the Chinese in general, I mean, when they have these sort of face-to-face, it's about saving face also. Right. And you think about this, the data that we see over there in China is not good. Right. It's deflationary. Right. And so at some point, they're going to export that. And when you think about a Walmart, this is a company that is down right now. The stock is down, 7% or so. This is a $400 billion market cap company that closed yesterday. It's down 8%, excuse me. So we're Thursday into the close here, down 8% off of an all-time high that it closed at yesterday. And it says a lot to me just about market or investor psychology or sentiment right now. It's not too different than Eli Lilly, which is a great story where investors were piling into it, crowded into it. Like if you look at the rest of pharma, it's a disaster, right? Other than Novo Nordisk, right? So that's the GLP-1s. And then if you go over and look at tech, and it's obviously the Mag 7, right? They're all crowded. So they're crowding into the biggest things perceived to be safe. And when I see a company like Walmart have to say what they did about the consumer, I'm not thinking that this is a one-day blip or anything like that. You know what I mean? And I want to take investors back or listeners back to September when Walmart was trading at then an all-time higher, a lower all-time high than it just made yesterday. But that stock again sold off 9%, but it did it over a matter of weeks when consumer staples were selling off, when rates were going higher, right? When the 10-year was getting close to that 5% range. So I think what's different now is the violent reaction that we had earlier in the week in equities, right? After that CPI print that was down 0.1% lower than what was expected. And to me, this is not bullish price action, in my opinion. It's just not. And so I want to look across the market today and I want to say, I see Cisco, okay, this is a $200 billion market cap company, down 11% after its earnings and poor guidance and lack of visibility. A Palo Alto Networks, which is an expensive cybersecurity company that is growing sales and earnings 20% a year, but trades at a very fat multiple. And investors shot first, you know what I mean, are going to ask questions later about that guidance. Those to me, I think are really important points at the end of this week that saw an orgy of buying after that CPI print.
Listen, I've been on this Walmart trade for a long time. I mean, I'm just going to buy it and hold it. I haven't sold it back in the mid 100 teens, like 115, 116, something like that. The theory was they were gaining on Amazon and e-commerce, which they are. That's a bigger part of their business. They were going to get the trade down from kind of the middle income consumer to come down, which they have. But you're right. There's a limit on how far Walmart can go. It's a giant of a company. This is not a company that you can meme. It's not a company you can pretend that can grow. It just can't. It's hard for them to outgrow GDP, right? There are some efficiencies. It's a great company. You can own it. I wouldn't sell it on this break, but again, do you buy more on this dip? I'm a buy and hold guy. Let me just say one other thing, because I think a lot of this dinner last night, right, with all these CEOs and Biden and everybody was, a lot for show. China, the Bank of China yesterday, right before that, pumped in $200 billion into the system. Okay, that's not a coincidence. And it was supposed to be, I think, like 120. So let's just call it 200 billion. So 80, maybe 70, 80 billion more than was expected. They had 2 economic data points yesterday that weren't terrible. So they weren't bad. So give them credit on that. And let me just say this, I'm putting my bullish hat on. I mean, oil is down a lot, right? Rates are down, not a lot, but it's down. Gasoline is down. This is a positive going into holiday spending season. I'm just saying, there are positives that can occur in the midst of all of inflation coming down that actually have an economic impact, right, on people. So I can take away some positives and plug it in. So I just don't want to be negative all the time, but those should be positive for some type of discretionary income.
It's interesting, the commentary, again, I don't put I understand why people be optimistic, and I understand as a politician why you want to take a lot from this and use it through a positive lens. China will not fight a Cold War or a hot war with anyone. China never bends against the United States, never interferes in its internal affairs. I mean, President Xi said all the right things, but actions speak louder than words, and I've said a number of times, we have paraded, I think, 4 different people to China over the last year or so. Janet Yellen, Blinken, Kerry, and somebody else whose name, Gina Raimondo, I think. And each time they came away saying all the right things, only to have China do something that sort of flew in the face of those positive developments. So we'll see what happens here. But on the surface, all good things. Market loves stocks. I get it. And I think, Danny, to your point, and Dan and I have had this conversation in Market Call, it's a very one-dimensional, it's a Pavlovian response. Rates are going down. The Fed's going to move quicker than we thought next year in terms of lowering rates. I don't really care what the fundamental landscape is. The Fed is all that matters. I don't want to wait around till next year. I'm going to get ahead of this, and I'm going to get long the market, which, listen, as I've said 100 times, the reasons why, if you're long a stock and it goes up 15%, you've made 15%. The reasons why don't necessarily matter in terms of the math, but the reasons why at a certain point should absolutely matter, because although we're seeing stocks going higher, we're seeing the fundamentals deteriorate right before our eyes.
Games people play. And let's keep in mind that rates coming in like this in the 10-year does not help most people, right? It doesn't. This credit card debt and all the stuff that's just multiplying, going higher, is more prone on the shorter end of the curve. So while a Fed cut would be helpful at some time, we're months and months away from something like that occurring, right? So again, I think it does help the companies that can access credit to price lower. Debt prices will be lower in terms of coupons that they're going to have to pay. I think that will be a positive. But I want to equate, if I could real quick, I told you last week to kind of read bank conference call transcripts and private equity. They're telling you what's going on. The equivalent of bank reserves is the same as retail inventory. What do I mean? All these retailers that we're talking about have been around for many cycles. How do they manage their risk? They manage it by not carrying too much inventory. How do banks manage their risk? They make sure that they're reserved on credit and they pull back on the loan growth, and they're much more selective on the underwriting. It's the same thing. Again, I would read every one of these transcripts because it's a fun thing to do, guy, especially on the weekends. You can skim through these things in 5-10 minutes. Read Walmart, read Williams-Sonoma, read Macy's, read these things, and I think it'll give you a better picture of kind of what's going on.
No question. And again, Jamie Dimon, Dan, has talked about, I mean, he seemingly is now, he's become a Fed official in a lot of ways, because you hear from him on a weekly basis, and he was out earlier this week saying again that he didn't think the inflation dragon was slayed by any stretch of the imagination. And he's not talking any book here. I don't think he's necessarily vying for some position. I actually think he's trying to shine a light on some of the things that he's seeing. Whether people listen to him or not, it's your decision, but he obviously sits in a pretty important seat.
Yeah, well, it's interesting after the Fed meeting and the auction when rates, came in for the 10-year from 5%, so that was, 2 weeks ago or something like that. And, the big concern was when equities shot back up is like, okay, what does this mean for financial conditions? Because the last thing the Fed really wants them to do is ease too much. And so to Danny's point about kind of the pulling forward of expectations of rate cuts next year, I mean, we haven't even felt the long and variable lags yet of the rate increases, right? To your point, Fed funds is still at 5.5%, despite the fact that the 10-year is now at 4.45. I'll just make one point about the 10-year. If you look at the uptrend of this 10-year yield, okay, so in early May, I think it was like 3.25 or so. And if you just kind of attach the July low to the August low, we're sitting right on that uptrend at 4.45 right now. Okay, so that's just a technical thing, right? And so maybe these auctions, maybe they go better than you expect.
They're not.
I'm just saying hypothetically, right? Like, again, I will tell you guys this, that the reaction in the stock market on Tuesday to that CPI print, that was one of the most surprising things that I have seen in the markets in a very, very long time. The fact that the S&P and the NASDAQ gap 2% in a straight line
That's
like
panic.
that.
It's funny. And real quick, Dan, we talk about panic. We always associate in our world, if you hear panic, the next word you hear is selling. It's like, again, Pavlo, it's just one of those things. They go with each other. The panic that I've seen again, I haven't seen panic selling in quite some time. What you saw earlier this week, Dan and Danny, and Dan, you can sort of opine, was panic buying. Like, get me in horizontally, as they said in the movie Wall Street.
That's kind of my only point that I wanted to make is, so I'm bringing up this chart of the 10-year U.S. Treasury, and you guys could just pull it up on your own screens here, and you see this uptrend, and it really feels like we did top. And so if we break this uptrend and we go, and Carter was on Market Call talking about he sees the 10-year back maybe at 4.15 or something. What does that mean for equities? And Danny, I want to attach it to what you just said when you put your bullish cap on, because you seem to take it off really quickly. But the idea that oil today, as we're talking, is trade crude oil at $72.50, okay, down 5%. That is a massive move. And what does that mean for gasoline? What does it mean that rates are lower? What does it mean that the dollar's lower? I mean, there's a whole host of things that you could say if you are literally wearing blinders and you are not paying attention to any of the geopolitical stuff or whatever, and you're not worried about what stagflation means for U.S. risk assets, then you're buying stocks. If you were just a program, if you were just an algo and those are the inputs, and that's what happened. So my only point is that just as surprised as I was as the market's reaction to a 10 or 15 basis point move lower in yields off that CPI print and what it did to equities, okay, where they are off their lows in the last 3 weeks or so, what happens if the 10-year breaks that uptrend and goes back to 4.15? You tell me, Danny, at this time of the year, because we're in earshot of that 4,600, the 52-week high in the S&P 500.
Yeah, the thing that I'm kind of laughing at the course of this week has been the praise of Janet Yellen. That somehow people believe that she is going to, that she has, and she will continue to thread this needle of bond auctions. I got news for people. Like, we're still competing against 7.85 trillion on the Fed balance sheet unwind, right? Most of that in treasuries. So we still have to fund this deficit. We have this debt outstanding. You can pretend that a week goes by and, oh, the auction must have been successful because rates are stabilizing and moving lower, or she's going to be able to pull this off because. So don't let the stock market or bond market, as Dan just pointed out, fill in the reason that you want to believe. I mean, you can choose your adventure, and good on you if you want to keep it simple and everything like that. But that to me is a joke, because a $2 billion less here there. And the funny thing is, she's moved everything to kind of the shorter end, obviously, of the curve near term. Like I said, I was joked on Market Call the other day. They should be backing up trucks out of DC right now to just take advantage of this move and sell as much as they can to this market right now. So,
Danny, if you want to sing these lyrics, be my guest, but I'm going to just add a few other things. If I promised you the moon and the stars, would you believe it? You want to sort of sing that? Or you want me to continue?
That's the games people play still, isn't it?
Games people play in the middle of the night.
But go ahead.
You know what? We've been promised the moon and the stars in the form of this. I can't even believe I'm about to say this. Soft landing. That's the promise. That's the moon and the stars promise.
That was like Fonzie saying, "I'm so."
It's hard for me to say certain things. Meanwhile, U.S. continuing jobless claims highest in almost 2 years. 1.87 million in the week that ended November 4th. 8th straight week of increases. So, what is my point? Jobless claims are going higher. The unemployment rate is going higher. Now, what they're promising in form of the moon and the stars, Dan, is we can control unemployment. It's going to tick higher in a linear way, and when it gets to a level that we deem adequate, everything's going to be fine because we'll be able to stop that. We'll be able to shut that spigot off. That's the promise of the moon and the stars. The reality is they're full of shit. And the same way they think the Federal Reserve, can control the unemployment rate is the same way they thought they can control inflation, which clearly they had zero control over. So what I've said, Danny, is you're going to start to see a non-linear move higher in the unemployment rate. 3.5 to 3.6 to 3.8 to 4.2 to 4.7. It's like, holy shit, one day we're going to be like, this is a little out of control, this is a little scary. And at some point, the market's not going to react too favorably to an unemployment rate that's going to move in a non-linear way, Danny Moses.
I mean, at what point do earnings and fundamentals projections for 24 take over this game of when is the Fed going to start cutting? Because we've talked about unemployment. I think it's 0.5% up off of its lows. When you have a move like that in that direction, it's pretty 100% proof that, that something bad is happening in the economy, or at least is slowing, or something's coming. So you're going to have this gap. And I've kind of felt like right now, this is the intermezzo guy, right? This is the kind of palate cleansing part of this cycle here and what's happened here. And some people may choose to get a great entree that's coming and it's going to taste great. I believe there's a shit sandwich coming potentially to
By the
people
way,
that actually believe
quick,
that.
just so you know,
can I
Dan,
say
I know.
that?
Hold on, before you say, you just did. Shit sandwich was what the critics called Shark Sandwich, the album from This Is Spinal Tap. Remember, they came out with Shark
put it on
Sandwich,
11.
and
Put it on
the
11.
critics said they should have called it Shit Sandwich. Anyway, I digress.
I'll just, one thing I'll just say here is that I think we got a lot of these themes right in 2021 when the market was still kind of raging, and kind of called the really what was going to happen in some of these like long duration risk assets, right, in a higher rate environment. And so that kind of carried through all of 2022. And yeah, so okay, the S&P is up 17%. It's just rallied 12% in a straight line over stuff that I think caught a lot of folks off guard. That's how you have moves like that, right? Is like people are positioned incorrectly. Danny, you've been highlighting that over the last few weeks or so. I really still feel that the stuff that we're pointing out here, that a rate decline or quicker and more, I guess, violent than expected, rate cuts by the Fed, this won't be good for stocks. At least that's what everything that I've learned over the last 25 years. And then I'm going to go back and I'm going to look at the Russell 2000. I'm going to say to myself, it's basically flat on the year, even after all of its rally over the last 2 weeks. I'm looking at the equal weight that's only up a couple percent or so on the year. Not particularly bullish to me. So the more you concentrate in these names and you want to focus on the S&P, again, up 17%, the NASDAQ 100 up 44%, man, it is just such a narrow group. And the last thing I'm going to say is, Guy, you just mentioned that we were down, the three of us were down at the CME Cup, okay? And this is a Pro-Am, and Terry Duffy, had a lot of his friends down there to play in the Pro-Am, and we spent 2 days talking to a lot of these folks. These are all either very successful people in business, okay, away from markets, or very successful people that he's known along the way in his multiple decades on the CME, right? And we had dozens of conversations with people who listen to us, who watch us on CNBC, and they appreciate what we do. How many times did we hear, oh, you guys are not like the cheerleaders, okay? So our value prop here, people, we are not your hedge fund manager. We're not your RIA. We're not your stockbroker or this and that, whatever. We're guys who show up every day and we talk about this stuff. And hopefully some of the inside baseball and some of the views that we have based on people that we're talking to in the markets and this and that or whatever are helpful to you, the way you manage your money, the way you think about it. Our assumption, though, is that you are obviously invested, like most people are, in funds with fairly conservative, you know what I mean, sort of. But if you're here watching us every day or listening to us every day, it's that you enjoy certain aspects of the market, trading these different risk assets, thinking about the relationships of this stuff, and trying to figure out different instruments and the way to express views in the market. So, that's my 2 cents. And my takeaway, Guy, and I want you to opine on this, is that when we have successful folks in other walks of life who appreciate the honesty that I think we bring to it, and Danny, you've always made this point, you're here to help people and the like here, that's to me why we show up every day. And I'm not doing it for the Chimolis on Twitter at all. Like, I could give two shits.
Spell Chimoli.
Well, you know what I'm saying? Like,
I
the
do
peanut
know what you're
gallery.
saying.
You know what I mean? Like enough of that crap.
I am upset. We obviously want to be right in our assertions and some of the things we talk about. But what I can sleep well at night knowing that there's an integrity to what we've been doing for quite some time now. We are pointing out some of the things that we see, some of the things that can go wrong, and historically some of the things that led us down a very dangerous path in the stock market. I'm going to say this, and it's going to sound, it would be easy to come on each week and be bullish. Now, people will say, well, it's also be right, and I totally understand that. I totally get it. But my point in saying that there are no ramifications, Danny, for being constantly positive, bullish on the stock market, because when things invariably go pear-shaped, there's sort of this safety in numbers thing. Putting yourself out there and sort of pointing out some of the things that we see flashing red all around us, I don't want to say it's difficult, but I think there's an honesty to it. At least that's the way I view this entire thing.
If I'm telling you the truth right now, do you believe it?
Mm-hmm.
I'll quote another line, from that song. But we were actually talking. We were down in Naples, and we were talking about how we kind of wanted the market to cleanse itself, so we could, certainly, just become, I don't know, not more bullish, but more constructive, as Dan likes to make fun of me when I say that, and Vinny and Porter make fun of me when I say that, because you want these things to get to a level. And listen, I'm a contrarian. I like to think away from how the masses are thinking. Normally if you're short, even if you're right, your timing's always going to be off. But again, I'll say this again, don't be long bad business models, and don't be long bad business models in an economy like this, because rates are moving higher and credit's going to be less available. To me, that's the key. And there's a couple companies I want to harp on.
Well, hold on, because I was going to tee you up with that. Business models. I mean, if you think about one of the most popular companies over the last 20 years that we've all frequented at one point or another, that you can't walk 20 yards without bumping into one in New York City, that's Starbucks. And, there's a fancy word for their employees, and it should be, because barista. I learned this word. But apparently, Danny, you brought this up. There are a lot of unhappy people in the start. Now, you wouldn't know it from the stock performance over the last couple of weeks because the stock has been a monster. But below the surface, I think it speaks to, some unhappiness out there.
Yeah, for the second Red Cup day, they have it annually. That's when they give away this holiday cup. You get refills or something like that. There was a walkout. Now, no one really paid attention last year, I think, because there was 113 out of the 10,000 stores were partaking in kind of this walkout. So it wasn't a big deal. But with everything that's gone on recently in the last year with unions and the powers that they're getting, and people were caught off guard, I think, by the length and the extent of what the auto companies ended up giving to the union. I think this is being underappreciated. And, there are now way more people on strike today than they did last year. And I think this thing's going to feed on itself. I think we're in that type of environment. They have 400,000 employees, right, in 200 cities. And New York City's on strike today, a bunch of these stores. And yes, I think the stock is up, obviously, because they just had strong numbers last week or a couple weeks ago. And everyone's feeling good today about China. So that's good for Starbucks in general. But that stock is not cheap. And I'm not saying to go out and short it, but sometimes in this market, the most obvious things they're right in front of you. Like, this is not going, this strike, my guess is we're going to hear more and more. This is not a one-day thing. And if they unionize, remember, this started 2 years ago in Buffalo. And since then, there are stores that have unionized. I don't know the exact number. It's very small. I think it's, 350 out of the 9,000 or 10,000 have some form of union, right? But so think about that. Anyway, talk about margins getting, hit in certainly a very expensive product, in my opinion, what people pay for coffee. Put that with unemployment potentially moving higher. I don't know. I haven't done enough work on the name. I'm just thinking that it's being overlooked.
I'm going to go
another name.
I'm going to I'm going to go from Starbucks, and I'm going to give you to another star. I'm going to go from Starbucks to Starlink, and this puts a ball up on a tee for you. Which, by the way, I would have done if we had played in the Pro-Am. I would have teed your ball up, but I'll do it here, sort of in a metaphysical way.
No, listen, this is Wall Street 101, right? So, I mean, Elon Musk, I don't know, make a comment on this guy. He doesn't deserve any airtime at this point at all, but he owns 54% of SpaceX. Starlink obviously is a big part of SpaceX. There's rumors that they're looking at an IPO. I wonder who the banker would be for that deal. I'm just curious if it would potentially be Morgan Stanley or maybe some of the other bankers, which hold some of his loans. 1, 2, he needs liquidity because he's day by day just bearing Twitter into the abyss. There's less and less value there. And to me, so you want to put your cynical hat on, great. I hope everyone that's invested in SpaceX gets to make money. And you think about who owns SpaceX, it's Fidelity, it's the Founders Fund, right, et cetera. But Musk owns 54%. So I believe that rumor is true. And I think we will see something like that occur in Q1 2024. But the reasons are Morgan Stanley needs to get paid and Musk needs liquidity. So that would be the catalyst to get that done. So
we have reached week 11. I can't even believe it. The NFL season is a blur in the league where they play for pay. Danny Moses, your record is a robust 17-13. Some bad beats along the way, but you know what? That's the nature of the beast, okay? That's just the way it is. But as we've reached this week that we like to talk about, bring forth your picks as you continue to build upon what's been a bounce-back season for you.
When I was 13 and 11, I think I told you that I would be 20 and 14. I said when I get
don't
to the
touch the money. Don't touch the money.
I know. I'm just saying. I still stand by that. So a couple interesting games. Obviously, a rematch of the Super Bowl. Philly going into Kansas City. The line is kind of moving between 2.5 and 3. I'm going to take the Eagles. I'm going to buy the half point, even if you're laying minus 120 for people out there. Just do it. I'm not going to let 2.5 dangle out there. So Eagles +3. Both are off of bye weeks. I think Philly's the better team. Kansas City has not impressed me. A team that has impressed me that lost to Kansas City that was also on a bye week is Miami. 2 weeks to prepare for the Raiders. The Raiders come off 2 wonderful wins. Good for them against the Jets and the Giants. Okay, I think, Guy, you could get some people at Don Bosco and probably
as it turns out, we have the quarterback from Don Bosco.
Yeah, no, and he's really good. But anyway, so Miami's laying some serious wood, 13.5 in Miami. I think they're getting healthier. I think they're going to stomp on the Raiders. This is a wake-up call, kind of the little Antonio Pierce, another giant honeymoon. Might be over flying east after late Sunday game for 1 o'clock start there. And then the last game, which I'm just going to do, again, I'll rank these are in order, obviously, of how I like them. I think Dallas stays hot. They get to these periods where they look great. Laying 10.5 in Carolina. Frank Reich takes back over the offensive coordinator role for Carolina. They're lost. Dallas, nothing like playing the Giants to start feeling good about yourself, guys. So give me Dallas laying 10.5. So there's 2 big spreads I'm taking there. One is a home and one is a road favorite. So those are my 3 games there.
What we've learned in the NFL over the years is the bigger the spread, the more likely the team laying it is to cover. I mean, that Giant, you said it was 16.5 last week. I mean, think about what the Cowboys did last week. They got stopped on the goal line with their first drive, and they were still beating the spread by half. It's whatever. I'm apoplectic.
I had a cash out at halftime for 95%, I think, of the bet it was going to pay already, but I wanted to hang on to
Of course you did. 5%. You wanted to
By the way,
you wanted to
get my Steelers, although they're not, I don't think, but my bet at the beginning of the season, 100-1, Eagles, Steelers, Super Bowl, and I said that division, anyone can win that division.
I agree.
Bengals, Ravens, Browns. So anyway, we'll talk about that.
The Steelers have been winning ugly, ugly. UGLY. You look at that, like, how is this team winning? But they're getting, each week they're seemingly getting better, which is what you want to see. You want to see that trajectory, as opposed to the Chargers, who just can't get out of their own friggin' way. But that's another story. There's another line in that song, by the way. Ain't gonna spend the rest of my life quietly fading away. That's off of Games People Play. But there's a gentleman that is nothing. He is not fading away. As he gets older in his career, he is only getting stronger. He's the antithesis of this shitty Game People Play by the Alan Parsons Project. So when we come back, and stick around, we're going to have a wonderful conversation with the great non-fading away Terry Duffy of CME Group. I look forward to certain things in life. Christmas, Arbor Day. But when I'm together with Terry Duffy, which happens a few times a year now, those are days and those are times I look forward to. And Terry is joining us here on the On the Tape podcast. Terry, how are you?
I am doing great, Guy. Thank you for being here.
Well, I mean that, by the way. And we've known each other a long time. And in an era where people bounce from job to job, sector to sector, company to company, you've been with CME Group now since the 1980s. How long exactly, so the folks at home can know?
43 years, Guy. I started at CME making $56 a week. So it's been a long time there. Then I traded, as you know, for 20 plus years, and then been in management for the last 20 some years. So it's been a long time. But it's been a short time at this, all in all as well.
Blink of an eye.
Yeah.
But it speaks to your commitment. And furthermore, obviously, it speaks to the granular understanding that you have not only of the business, but of your company. So just through earnings, a lot of things are out there. From 30,000 feet, speak to us about the health or where the CME Group is now and where you want it to be.
Well, the health of it, I think, is great. We were talking before we got started here, and I've talked to you guys prior to this. As you know, I wrote an op-ed talking about how I believe it'll be a risk management type of world that we live in, and people need to manage that risk. There's so much uncertainty in the world today. So we're seeing a day like today where the CPI number comes out and everybody gets euphoric, but I didn't hear one pundit talk about what's going on in the Middle East. I didn't hear one pundit talk about what's going on in Russia and Ukraine. I didn't hear one pundit talking about what may happen in China and Taiwan. So the global uncertainty is something much larger than what the core inflation number is in a 30-day period. But, I get it and I understand that. But my point is people still need to manage risk. So CME is in the strongest position to do that. We have the largest rates franchise in the world. We're seeing record open interest in our interest rate franchise. Regardless if people believe that they're topped out or not topped out, it's irrelevant. Because if the market was to to sell off a little bit on the rates, or the bonds were to rally, the treasuries were to rally, then we would see additional volumes coming from that, not less volume. So I think it's a bit of a misnomer about how CME actually works. Sometimes people look at it as a defense stock, like a utility. It's far from that. It's a growth stock that has multiple asset classes, no matter what the scenario is. We live in a dangerous world. So, from our standpoint, we think it's really important that people know how to manage and mitigate their risk in all these different asset classes that can be affected, not only by geopolitical, but for people to assume that the Fed is done. And if they are, okay, fine. But it doesn't mean that your cost of refinance goes down because the Fed is done. The only way your cost of refinance goes down if the Fed acts to the downside, and we have not seen any indication that they're going to do so. Fed fund futures are starting to price in some cuts coming into 2024, but again, those are prediction markets.
It's interesting, Terry, you glossed over this. It was an FT op-ed that you wrote. It was February 28th. The title was Risk Management is the Alpha for a Time of Uncertainty. So it was fairly prescient if you think about what happened, what played out over March. Talk to us a little bit, because again, you also said this, I think on CNBC on Fast Money in July. You said nearly everybody I've talked to over the last 12 to 18 months who've had some sort of thought about what the Fed is going to do have been wrong. Okay, so when you put that together about people trying to game the Fed, and they're trying to do it again right now, I think that's the point you're making on a day like today, where the markets are screaming, rates are down a lot on one CPI print. It was literally expected to be 3.3%. It came in at 3.2%. Okay, so talk to us now about, we've been through the banking crisis in the spring, and now we still have a whole heck of a lot of uncertainty, all those things you just listed. How important, what should our listeners be thinking about some of the products that trade on the CME? What should they be focused on? Because you guys have seen tremendous volumes in different asset classes.
I think you got to be focused on a handful of things, and today's a great example. When you look at the print that we just discussed about the CPI print, and the Dow being up 500 points, the Russell up 5%. Some of the small cap markets have really caught on fire, but they've also been hammered. So we're looking at a whole host of things here. But I think what's interesting about that is, look at gold. Gold's up $20 today. Why would gold be up $20 today if, in fact, that the Fed is going to cut rates? The dollar's off a little bit, which would make sense if they think the Fed's done. But why is gold up 20? Why did oil all of a sudden catch a bid overnight instead of being sold off even more consistently? So I think we got to look at that CPI number, and it's a core CPI, as we know, which excludes food and energy, which are the most vulnerable components. And we don't live, 5 years at a time. We're living moment to moment now. And that's just the world that we live in. As I referenced earlier, we've never seen a war on the ground in Europe with boots on the ground since World War II. We're in that now, as I referenced a moment ago. So I think we're in a different scenario. We don't live 5 years down the road. We're literally living moment to moment.
I think there's a seasonality to this, right? We came into the start of the year. People obviously were long financials and energy, kind of short tech. They were somewhat positioned defensively. We're now at the backside of the year where people are forced to chase, right? Because from a performance, I really think that's all it is. You guys are obviously in the thick of it in terms of the products that you offer. And I want to focus on the innovation which you guys have had, because you've introduced a lot of new products. It feels like the most you've ever introduced, I could be wrong, over this last year, to accommodate risk management, to give people the ability to do that risk management. Talk to us maybe about how you guys come up with those ideas or those type of products. And it seems like these things are taking hold too and gaining some footing.
Yeah, Dan, it's a good question, because there's new products and then there's derivatives of old products, and you have to keep. And so sometimes people say, well, geez, that's not a new product, or that's just a derivative of a derivative of a derivative. Yes, but the times have changed where you need to modify some of these contracts, so they're technically new. The greatest example of that, Dan, is when the LIBOR decides to go away. That's priced hundreds of trillions of dollars benchmarked to LIBOR. They give us a certain period of time in order to transition into something else. SOFR in the United States, SONIA in Europe, into these new reference rates that are pricing all these products. And we're talking about moving trillions of dollars of risk from one benchmark to another. So Eurodollars, the short-term interest rate contract, which is the largest in the world at CME, is now called the SOFR future. So we innovate in that respect and bring in new client bases. But the new benchmark in SOFR doesn't have the credit component like LIBOR did. So now you're looking at other products such as Etsy, which is another smaller credit contract based out of Europe that we have listed to help people mitigate and manage their risk. We're working with Bisbee and Bloomberg in order to bring in some of the risk offsets for these people that have credit exposures. And now who would that be? These are the largest deposit banks in the world. So whether it's JPM, whether it's Wells, whether it's Citi, just to name a few, those are big deposit banks, where Goldman's not a big deposit bank, they're more of a trading operation. So, but those banks need to have some kind of credit component in there. So we look to bring in new ways for them to mitigate their risk in rates. And then in energy, we do the same thing across in that asset class and across the rest of the products at CME.
So I just want to follow up on one thing. Your risk management, your internal risk management, you obviously have to monitor your clients that are out there. Is that changing? Are you guys doing more in that area? Granted, you always do a lot there. That's most important for you guys. Are you noticing a little bit more risk that's inherent in your clients, with your clients potentially?
You have to think there's more risk inherent in the client base. Why is that? So one of the things I did say on your network just a short period ago, I was on with Carl and Sarah. I was talking about duration risk, and I was talking about supply and demand on the issuance of treasuries. And if in fact that the treasuries, we have to manage this risk. When we're holding 90% of our margin between cash and treasuries, and then 10% in other instruments such as gold warrants and some small corporates, but it's primarily cash and treasuries, you need to now efficiently haircut them more just to make sure you're being a prudent risk manager. So, we do. And one of the other things I did at CME, this whole back to work thing has been a very difficult getting people back into the offices. One of the things I did, I went to my entire risk team around the world and I said, I'm sorry, but I have to have everybody in 5 days a week, and that's it. There's no other way around it. I mean, I'm handling other people's money. We're holding, $300 billion of client monies that we're managing that risk for. I cannot have somebody, opening the door for their neighbor as they're supposed to be managing risk. And I'm saying that a little flippant, but what's mostly important here is we have all of our risk people in from all over the world. So those are a couple of things that we're doing differently, and we have to reinvest in those folks, but we think it's the right thing to do.
As I've said 100 times, I think the absolute world of you, and I think you're one of the top CEOs in the country, not in the financial space or whatever we deem exchanges to be, but in the country. And I'm biased, but it doesn't mean I'm wrong. Leads me to this question. You live this because in our world, you have to live it. It doesn't go away at 5 o'clock each day. And a good example, I think, happened last Friday when you saw that Moody's puts the United States on credit watch. I guarantee that within a few minutes of that, you were having conversations with people because your business, your franchise is affected by decisions and statements like that. Can you speak to the real-time aspect of that?
Yeah, and I think that's really important, but that goes to the risk management that we do each and every day, all year long, to make sure that when situations like that arise, that we're not caught off guard. We are pricing a lot of that in when we do our risk management, that there could be something coming down the pike, such as Moody's coming down and downgrading the U.S., and as we all know, the reason why is because it looks like Congress might not be able to get its act together again, so in return, they don't like the government. We've seen this before. They've done it before. Other rating agencies will continue to do so. So these are things that we've seen in our playbook. But to your point, Guy, I think the experience of being in this industry for as long as I have and a lot of my colleagues have, and of course all you folks, it's really important that we understand this. We don't have all the answers, but we need to be prepared for what we don't know what's coming next. And that's kind of how my philosophy is running the business.
All right, let's talk about this, because last year in this pod, from this place, you kind of went viral, Terry. I don't know if your kids ever expected that to happen.
I didn't expect it to happen.
I don't think we did either, but it was a great moment, and we were talking about, at the time, I think FTX was kind of coming undone a little bit, and you kind of shared a little bit of a conversation that, when FTX was pitching you guys, your firm, about some stuff and some of the interactions that you had with regulators. So if you think about that period last fall, and then what we experienced in March and April, and subsequently with the regional banking crisis, let's talk about regulation, because you had some choice words with somebody who is there to regulate the financial industry a little bit. What have you seen happen that you're maybe pretty happy about in the aftermath of FTX? And then is this stuff that's kind of working its way through more traditional banking, what we've seen, since the SVB and a couple other banks went under in the spring?
Yeah, Dan, that's a good question. And first of all, I'm never happy when anything detrimental happens to the financial services industry. I don't think it's good, whether they're a competitor, friend, foe, it doesn't matter. We don't want that. The ecosystem is critically important for all of us to be successful globally. So that's what makes the markets better. That's what makes them more credible. So I don't like to see that activity. So when we look at what happened a year ago with crypto, what has changed? I think one thing that has changed, I think there's a pause now. When someone comes up with a new concept or a new idea how they want to, bring product to market, I think there's a lot more people asking questions today. versus the FOMO issue of fear of missing out. I think there's more of that today, so that's the good part about it, because we want people to do their due diligence. I think Sequoia and some of the other Silicon Valley PE firms went in there and they were quite surprised that they thought they did diligence, and when they look at it, they didn't do diligence. And so I think it's really important that now people are understanding that let's not get over our skis. There's always going to be new concepts. We're going to move forward. I'm a big believer that market structure is going to change. I think everything has a shelf life, and this market structure that we're in today is going to change. What's it going to look like? I'm not quite sure, but it's going to change because it's going to become much more efficient. Now, do cloud services providers help get us there? Do other technology services help get us there? But I assure you it's going to change to some degree. But we have to make sure is that they call them the guardrails today. We used to call them rules, Guy, when you and I were in the marketplace. But we have to make sure the rules are written by the participants who actually understand the issue. So artificial intelligence will continue to be the next great thing. And we all know that. But who's going to write the rules associated with this so that we don't have information coming out that we all believe is absolutely gospel when it's absolutely false? Traditionally, people in the industry would write it, but you can't have conflicted parties writing rules. It just doesn't work that way. So I think there's a lot of lessons learned from FTX, and timing is everything, Dan. So I do believe that as we look going forward, the next set of rules and market structure will be based off artificial intelligence, and hopefully we will have an opportunity to write good, solid rules that make the markets better, safer, stronger for everybody.
Your bullshit meter went up in a major way when
Really?
100%.
Nice.
And that, if you think about it, it's from your time on the exchange when body language, you understand what's going on. Our world used to be this giant poker game where you knew if people were bluffing or not. And I think you intuitively knew at a much higher level. But you speak about due diligence. Think about this. Elizabeth Holmes fooled people. And the due diligence from a lot of those investors were, well, that group must have done their work. Why should I have to do it? Because they would have done the work necessary to make that kind of investment. I'm going to follow them in. Same thing happened with Sam Bankman-Fried, quite frankly. But you saw something immediately. And again, I'm blowing smoke up your ass. But again, it's well deserved. So speak to just understanding people.
If the question is, how do the bullshit meter? So my bullshit meter did go up with him, and I'll tell you, and I think I said this to you last year. But what's really important, you have to have an understanding of knowing not what's just in this room, but what does the world really look like? So when I met Sam for the first time, and I thought to myself, what does this guy want? The reason my bullshit meter went off, Guy, is because I offered him, after he said he wanted to compete in crypto, my crypto franchise for free. And when he said he couldn't accept it because I wouldn't deploy his risk management, and I said, your risk management is flawed. Mm-hmm. And I said, so you're turning down free to institute your way of doing risk management. And that's when I said he's taking it in the front door and leaving it with it out the back door. There's no other reason why someone turns that stuff down. So that's kind of where I get my intuition sometimes. It's like when I was trading back in the 80s and hanging out with you and your hoodlum friends over at J. Aaron and Goldman Sachs. I
don't know who I have no idea what you're talking about. I plead the fifth on that entire thing.
But you go to the grocery store if you want to see what the price of beef's going to do and see what's in the shopping cart. Is there chicken, pork, or beef in there? You get in traffic and you drive in a city back and forth to see what unemployment's going to be. You look at license plates. Back in those days, you could tell which was a lease car, which was an owned car. Mm-hmm. You could kind of have a good feel what was going on in the world by just understanding what people's needs are. I don't think people do that anymore. And if they do it in such an algorithmic way that we see a lot of knee-jerk reactions to different markets. And rightly or wrongly, that's the world that we live in. Now we have to harness that.
It's funny you say hoodlum friends. I actually use the same term myself. But there's a word that we had at Goldman Sachs that I knew the definition of growing up, but I didn't really fully understand until I was there. And that word is rigor. And what you just described is rigor, being rigorous in terms of how you're we used to talk about scrubbing things. That's gone away. And I'll say this, now I'm on my soapbox. One of the reasons it went away, in my opinion, is because money was free for a long time and you didn't have to be rigorous. Right. Now you do. Speak to the importance of rigor.
Well, here, you and I can live in the past, which neither one of us do, but we've learned from the past and we apply it to the future. And I think that's what's really valuable to the younger generation. I've talked about this before. When you look at the people that are participating in the market today, and Danny Moses will know this better than anybody, the average age of a market participant is roughly 50 years old. They're managing, hundreds of trillions of dollars on behalf of others. So you figure when they got into the business 15, 20 years ago, the market, they were 30, 35 years of age. They never saw a downtick they didn't like because the last downtick was in March of 2009. And then all of a sudden we go all the way up to the pandemic, and all you had to do is buy every dip and you made money, and you thought you were a really smart trader. You weren't a trader. You're just a directional guy that caught, lightning in a bottle. It's no different than being the president of the United States. You can go look back in history and look at what president had to go through what crisis and what guy just cut ribbons and had a grand old time. And it happens. And I think that's what we're seeing with some of the marketplace right now. A lot of participants don't understand that there's two sides to this thing and you need to mitigate and manage risk. So, Guy, I think that when you saw what we were able to see, what Nathan and Danny Moses were able to see, you understand that, hey, something could go wrong here. It doesn't always last forever. So I think you have to put the rigor, as you refer to it, into the marketplace and understand it. And listen, I'm not a bear, I'm not a bull, I'm nothing. What I am is a risk manager. But I also understand to manage risk, you have to understand that things go up and they go down. The question is, what can you sustain when they go up and they go down? And if your only reason for staying in a market, and I think Danny Moses referenced this earlier, we might have a year-end rip because people are afraid to give the money back to their investors, so they want to put it to work, and they're just going to buy indiscriminately in order to potentially the markets go up, and they think that's the right thing to do. I think that's the wrong thing to do.
So one of the things you mentioned is you want people back in the office, and we're all old school here in terms of looking people in the eye, working with them. You can get a true read. I mean, the days of trading with open outcry and all that stuff going on. When you look at the market structure now, you mentioned it before, right? You have a lot of CTAs, a lot of quants that are out there. They're obviously trading your products. They move. You can see the directions go. It's a ton of volatility. It's one direction. That type of stuff that you see go on, and deep down that it's overcorrecting on either side, right? Overbought, oversold. How has that landscape changed? Because there are less, quote, people, and you made a reference to AI and how those things can trigger a movement, a crazy movement in a market. And I think we're going to have, not at the CME, but we're going to have moments where people get carried out on a trade because something goes haywire the wrong way. But how do you manage that, not manage that risk, but think about the markets when you incorporate the idea that it's a lot of robots these days that are trading?
Well, there is, but the robots used to be us, right? So we used to be the robots. We just weren't as efficient. So we're liquidity providers. Sometimes our spreads would widen during times of stress, and sometimes they would tighten when it wasn't as active. And I think we see that it just in a much faster way today. That's just technology. That's the marketplace. I really don't have a problem with that. My concern more is the misinformation that goes into pricing some of the products that could potentially happen. So let's give this an example. How about a government report coming out of the USDA that says the corn crop, the bean crop, or the wheat crop is going to be X, Y, or Z, but all of a sudden some inputs go in there before it gets to the marketplace that make it look like something other than that through artificial intelligence. That could be very damaging from a whole host of reasons, not only for the market participants, but how about for the people who are planning their crop for the next year, who we're all counting on to eat? So if they get bad information from the USDA because of artificial intelligence, that's just not a market move. That could be a starvation move too, right? Because they planned differently because they thought the numbers were going to be this, and they're not that. And sometimes you don't find out till it's too late. So, I listen, I love the markets like you guys do. I think they're extraordinary. I just want the education and the people to participate more and more. And I think, by doing that and giving them a platform where they can participate themselves, get their information themselves, and not have to rely on others in order to formulate a decision on how they want to manage their own risk.
That's a good segue. We just took part in the equity futures trading competition.
44. That's me.
That CME put on.
Finished 44th out of 3,500.
And I got to tell you,
No, that was me in the fixed
But
income,
here's the
right?
thing, Terry, I don't know if you know this. There were thousands of people participating in this. And we did the rates one, I think, the prior month. And I know that they have, you guys have a crypto one coming out in December. We're going to do that. We're going to have some fun with that. I think I was right behind you, Danny.
Until the last 2 hours.
But it was really interesting, Terry, that we could see the amount of trading that was going on. These are a lot of, just like our listeners, a lot of self-directed investors. And we've noticed this over the years. And Guy, you've been on Fast Money for what, 25 years or something like that?
Approaching.
Yeah. And so, for us who all started out institutionally in the markets, having access to all these products and these tools, it's interesting to see retail coming up the curve here a little bit, right? And so talk to us a little bit about the retail trader. It's been a funny few years. You just referenced the ease of buying the dip that a lot of new entrants to the markets over the last, call it 15 years have had. But you guys have created lots of products, event contracts, you've created minis, that sort of thing. And it seems like there's a lot more retail participation. We're at least seeing it within our engagement from our listeners and the communications that we have. It's not just trading stocks and ETFs anymore.
Well, here, I think that the retail market has been defined over the last 10 to 12 years, anywhere from a professional trader to a guy walking down the street that is either betting on the Vikings to win on Sunday. Now he's betting on the price of, oil, in the next hour. I think that's all going to change dramatically. I think the retail is going to become much more sophisticated. They're not going to become the easy money that people traditionally believe they have been. I think the tools that are going to allow them to participate is going to allow them to grow. So if I was looking out into the future and say, what part of the segment do you see could possibly grow? I think retail's got a good chance of doing that, but not in its current form. I think it's going to morph into something different and better for the marketplace. And so to me, that's what's exciting, because it goes to the fact of education is working. Education is painful because it takes a long time, right? So when you try to educate people on marketplaces, as you guys do on this show, as you do on Fast Money, as you do in your daily lives, it's hard to get people to pay attention longer than a nanosecond. So now that we've educated them, I think retail is going to really morph into something completely different, Dan. And I think that's really healthy for markets, because it won't be, as Danny Moses just referred to, the algorithmic machines trading. It's going to be a big chunk of it could be retail taking the other side of some of those algorithmic trades, and that'll make them be more efficient. So I'm really excited about the retail trade. And the way you get them there is what you referenced, Dan. You don't get them there by saying, here, trade a $250,000 E-mini 500 futures contract, with the multiple of 250 times. They can't afford to trade that. The margin on that is $20,000. Give them something really small that they can participate in. Let them walk before they run. And I think that's the real problem. It's like zero-dated options today. When people talk about zero-dated options, why are they so popular? Because people are selling premium. I was around long enough, and Guy, so are you, when we listed options on futures in the early 80s. And so most traders sold premium. Mm-hmm. Always sold premium, because what do you mean? They're going to give me money? I'll take that money, until the unforeseen happens and it goes up and they carry you out in not on a stretcher, Danny, but in a box. It's bad. And you're looking at zero-dated options today. I know that my friends down the street at Cboe are having great success with that. But again, those are premium option sellers, which is a very dangerous way to go about it. So I'm hoping, Dan, that the retail market understands that there's two sides to trade options, there's two sides to trade futures, and they can make a decision and don't look at what they believe is the quick payout on a single day, and it'll never come out of the money.
Robinhood is the antithesis of your company, CME. And you talked before about the average age of a trader. As of last year, the average age of a Robinhood trader was 34. You talk about not seeing anything. They gave them tools to hang themselves. I mean, they gave them, remember, the margin accounts were wrong on the options, all that stuff. It was the exact opposite of what's kind of been happening here. So you're seeing the maturation, hopefully, but you can't teach people who don't want to learn, who don't want to listen. It doesn't matter if you're trading tulips 500 years ago. There's a behavioral finance aspect to it. And we can try to educate people, and you guys did an amazing job, even in the tools leading into those trading vehicles on fixed income and equities. And I look forward to learning more about crypto, obviously, when you guys launch this thing here in a couple of days. But that aspect of it, education, comes at a price for a lot of people. And unfortunately, the majority of people will trade in meme stocks and trade in things, and they don't want to listen. So there's a part of people that frustrates me, and we do this obviously up here to do that. And I think you guys have really focused on that educational aspect of the business, which I think is, those are the clients that you want longer term that are going to kind of, engage in that. I want to make one comment before Guy goes. James Gorman, who I've kind of made fun of the last couple of weeks.
He's a very large client of mine. I think James is doing an amazing job.
Morgan Stanley's an amazing job. But think about when he became CEO, January 2010. Right? We just were joking before the TARP, QE1, QE2, QE3. Good for him. He just left. Right? You're a guy who has seen as many cycles more, who loved what you do. And I think he loves what he does, but I think he also sees like kind of what's going ahead. So how have you endured? I know it's your love of the markets, obviously. You wouldn't give it up for anything. But Tell me about the cycles that you've seen kind of and what keeps you coming back.
I think one of the things that keeps me coming back is every day is different. Yes, we can see repetitive risk in the market and we manage those, and that's just part of what we do. But for myself, I get to deal with regulators. Some might say this is very painful. I actually don't mind it. I actually like trying to educate. We'll go back to educate regulators, legislators. And, we have to become not only we're a federally regulated institution, but I've also had to engage with state houses, which is normally historically we never did. So now I'm dealing with state legislatures, and if all they see is a bright shiny object and they want to tax you, so you have to show them the benefits of your industry. I think for me that's a big part of it. When I'm looking at how I can enhance the value of my client, I think about that every single day. I think about how can I take $1, make it look like $5, and take the risk down to 75 cents, Danny. That's how I look at CME every single day. And how do I do that? Because of the things that we've been able to put into place in order to mitigate and manage that risk. I find that really exciting. I want people to know that they can manage their own risk without reducing completely their upside. A lot of people always say, well, geez, I'm not going to hedge because, I was right to market and I lost on my hedges. Well, okay, I understand that. There's a balance there in how you do it, but there's a reason why they call it hedging. So I'm looking at how do I eliminate friction? And this has been a big thing that I've been working on. How do I eliminate friction for my FCMs, or futures commission merchants, every single day? So if we took $1 and we passed it around this room, by the time it got back to me, it'd be less than $1. I want it to come back to me and be $1 again. So I want my clients to be able to get those benefits so they don't need to erode money in frictional platforms. I want them to use that money, that capital, the way they want to deploy it. And if it's for trading, great. If it's for other issues to grow their business, that's great. But we all need to reinvest, and you can't reinvest unless you create efficiencies. And that's one of the big things I'm trying to accomplish at CME. That's what excites me.
CME, the M is mercantile. I say
Yes, sir.
teal. The E is exchange, I believe.
It is. It
So
hasn't changed.
the C is what? The C is what in CME? Help me.
Charlie. Chicago.
Chicago. Proud sports town, Chicago.
Proud sports.
I mean, the
town.
Bears probably have the first 2 picks in the NFL draft.
for the foreseeable future.
For the foreseeable future. The Bulls are still sort of living on the good for them, by the
I
way.
hope Michael comes back because I think he can still play.
Well, you know what? Yes.
he sold the team now. He's got some free time.
He has some time.
Right.
Cubs, Craig Counsell coming in, exciting times.
Whew, he was expensive, eh?
He was. The Blackhawks, who have fallen on difficult times, just drafted potentially the next Wayne Gretzky. A lot of people are saying that. So you're saying to yourself, all right, guy, please, where are you going?
He's going somewhere with the Rangers.
It's not the 1970s
He's going to
either.
end up
This
with the
is-
I'm
Rangers
not.
somehow.
No,
Yeah.
see, you're wrong for once in your life. So this Gretzky person said, and people say it all the time, skate to where it makes me crazy. Skate to where the puck's going. Good for him. It's become copyrighted. 2 years ago this month, you did exactly that with Google. $1 billion investment. And people are like, where'd that come from? But think about how timely and prescient that move was. So speak to 2 years later, that Google
Also,
relationship.
C doesn't stand for cloud. Were you going to do the cloud?
No, I was
All right.
not.
It's all right.
Chicago.
Here,
That was a great setup, by the
Danny,
way.
it was
I don't know
hell-
where he was going.
I was lost,
I was
too.
thinking Ryan Sandberg.
I'm going through Connor
That's why
Bernard's
my
stats at
mind
St.
works.
Pat's and thinking, how many goals that guy
kid
had last
can
year?
play, by
he
the
can
way.
play. He's small.
Isn't he the next Connor McDavid? Isn't that what you say
Connor
now? Anyway.
McDavid is next level.
Yeah,
But
Connor
that's a
McDavid's
different
big,
Go ahead.
strong, fast. This kid is crafty. He's very good. A little Patrick Kane-ish.
Who might wind up with the Rangers, I hear.
Who, Patrick Kane?
Yeah,
He was with you guys, but
I
you
know,
guys
but
dumped him.
he's rehab. There's something called a salary cap.
Understand how
Oh,
it
anyway,
works.
please Google.
Google. I got confused where we're at. Google. So Google, yes, we did what I believe is a transformational deal with Google. We are integrating about 200 apps into the cloud. We're about at 65 right now, which is a little ahead of schedule. By year end, we were hoping to have about 50 by year end, so we'll be about 65 different applications into the cloud, mostly on our clearing and our market data. Again, these are efficiencies that are very exciting. I work with my clients to show them, hopefully we can get these markets into the cloud. And I've always said, and I will say it again on your podcast, I will never put a market into the cloud unless it's equal to or better than what I have today on our platform. So we will make sure that our clients are not interrupted one bit, but will enjoy all the benefits and the growth of a Google Cloud platform, in which we think it can be. They will be able to deploy different trading strategies that would take months or years to develop in minutes. And if they don't work, the cost is de minimis compared to the investment they would traditionally make in the way the setup is today. That's one of the benefits when I talked about, not only integration onto the platform, but also the inherent benefits of the cost savings to the client. That's what I'm trying to do. I want them to deploy different strategies, but if they don't like them, I don't want them to follow through with them. But right now, there's a major investment to do so, Guy. In the new world, you'll be able to deploy a lot of strategies for very little cost. And if you don't like them, you just take them out. And that cannot happen in today's world. So that's one of the great benefits of it. There is a lot of different issues as it relates to going into the cloud from day one, because you have people, like we talked earlier, they get set in their ways about what they think, how they think they can make money. It's no different than the retail when I was talking to Dan just a minute ago about the retail proliferation of growing in a different way. I think the cloud will allow people to do that. So the point is, you got to get them there. And again, I don't believe in just flipping the switch. I believe about walking into the cloud. I will take some of my less latency sensitive products and I will start to integrate them into the cloud without putting the latency sensitive products in there. So it'll be a very methodical approach towards this. And in return, I think it's going to be really good for markets for a whole host of reasons. We all know Google's got an amazing artificial intelligence capabilities. I'm hoping that we can work together with my clients to deploy them in a right way so they can grow their businesses and also CMEs.
So it seems like not only creating efficiencies for your clients, but also for shareholders too, right? And that's the promise, I think, of machine learning. We've heard you talk about that a bit, and that's something that you've talked about, I guess, since you introduced this deal a couple of years ago. Terry, you were at an industry event, I think it was last month, and you had this comment that really stuck out to me. You said, rather than talking to markets, sometimes it's better to listen to markets. And if you think about the markets and some of those active markets on your exchange, just think where yields, they were near 3% at one point this year. They got as high as 5 in the 10-year, and now they're back below 4.5. Crude oil, it was at 65 at one point, got to 95, and now, in and around 75. S&P, we know where all the futures. Listening to the markets right now, what are they kind of telling you? And especially, I know that that's how we kind of started the pod a little bit in reaction to this number. And, obviously investors positioned the seasonality stuff that Danny's talking about. Are you expecting 2024, just based on to what you're listening to, what's going on your exchange, to be maybe as volatile as we've seen in 2023? Because even if we were to close right here, and the S&P is going to close up 17% on the year, and the NASDAQ up more than 40, it wasn't an easy year for all intents and purposes. There's lots of risk assets that performed very poorly, lots of parts of the equity markets that performed very poorly.
Yeah, and it's a great question. I think if we all had crystal balls about where we think the market's going to go, we wouldn't be sitting in this room right now, but we don't. And again, I don't predict markets, I manage markets, but I will say the following things. From where I'm looking at the world and how I'm looking to manage the risk that you just referenced, I'm not seeing anything different in 24 than I saw in 2023. Forget about the price action. I'm just talking about what can happen in a very quick moment in time. And again, I don't think that people are, we talk about artificial intelligence, but artificial intelligence right now is only good as the inputs that you put into it. And when I'm looking at inputs that go into 2024, I think there's people taking some of the inputs and omitting them and then looking at their models about where they think the market's going to go. I referenced it at the beginning of your podcast here. I don't think people are really concerned about market activity as it relates to some of the things that are going on in the Middle East and then in Russia and Ukraine and what could potentially happen somewhere else. I don't think people are putting that into their models. And I think that's a big mistake. I think you have to make all the inputs go in there. So I'm looking at, a lot of volatility again going into 2024. I can't predict prices, but again, Dan, I think the market, I got to ask you what's changed outside of the percentages that you cited geopolitically. What's changed? We talk about a CPI number coming down, 0.1% and everybody's excited. I get that. And I get that people think that that's the end of it and the Fed's done. But what happens if the auctions for the treasuries continues to be a little wobbly? Well, we're going to have to pay people more in order to take that debt to pay our bills. Do people believe that that's going to drive interest rates down? I mean, that's kind of a bit of a stretch.
I think we have a podcast listener here. This is something that this has been a little pet topic of Danny and Guy for months now.
And I just listened to you and Guy on Fast Money, and then I called Moses to get the real scoop.
Well, I want to just mention, because I know why we're here, and one of the things that Wall Street participants, Whacker Drive participants don't get credit for is how much people give back charity. It's the one thing I think that people, whether you love Wall Street or don't love the business at all, it's the one thing. And you've been adamant, and you've done this now for years, and what you've done for women's golf. I know you do a lot of other things, but women's golf, why we're down here. So maybe talk about how this thing started. I know we're going to partake tomorrow in the pro-am, at least I am, and Dan and Guy are going to, maybe clean clubs. I'm not sure exactly. But talk to me about this event, because it grows every year, and it's really
there might be
really,
a lot
really
of club
amazing.
cleaning tomorrow too, because it's supposed to be some rain. So bring extra towels to wipe down Moses' clubs between shots.
Yeah.
Danny, this is an amazing event for a whole host of reasons. One, it's a unique event. We bring in people clients from all over the world. They get to see things that you don't normally see on a daily basis. Like we have Carrie Underwood coming here to do a charity concert for St. Jude. Last year we had Keith Urban do the same concert. I mean, it's just amazing. These people come in. We give 100% of the proceeds to St. Jude. I also have Nicole Kidman coming, and she's from Nashville. Not from there, but she lives in Tennessee, dear friend of mine, and she's going to do a fireside chat with me. Again, all those proceeds go to St. Jude Children's Research Hospital. That to us is really important. And before that, Danny, as you know, we were very big with Wounded Warriors, and we still are. We don't have them as our title charity, but we're still very big with Wounded Warriors. So CME is not a one-trick pony as far as giving money to one institution. We give it to a lot of institutions. I just started a new thing back in Chicago about giving money to young girls and young women, because I think they're the most underserved constituency of leaders that are being not taken care of. And in return, the kids, have a tough time if the mother is not being in a place where it's a safe place for the mother. So we are, we put together $2 million fund for women in Chicago to help them continue to have a better life so they can raise their children in a better way. So the golf with the LPGA, I'm a big believer in parity. I'm a big believer that when I hire somebody at CME, I don't look to see if they're a man or a woman. I look to see if they can do the job. And if they do that, if they have two people doing the same job, there's no way a woman's going to make less than a man at CME Group. We don't subscribe to that. And even though Guy and I come from a very old school background of trading, we also both believe in the world that we live in today, and that's doing the right thing. So that's what CME tries to do.
Hey, listen, you inspire us. We've been down here with you. You guys have been tremendous supporters of what we're doing at Risk Reversal Media. And again, we're going to do a $10,000 match, and it will be $10,000. We hope you guys step up. We're going to do a hat giveaway. People love our hats. Like we have these on the tape hats, these market call hats.
Yeah.
And so we're going to give just, what to do. People, make that minimum $25 donation, send it to contact@riskreversal.com to St. Jude's. We're going to put the donation link in the show notes, and we're going to send you a really cool on the tape hat. And we're also going to be giving, we'd love to hear more about what you're doing in Chicago with women and maybe that's something we will support in the not so distant future also.
Well, I can't tell you how much we appreciate your donation to St. Jude. I know St. Jude appreciates it, but just you guys taking time out of your busy schedules to come down here shows that your compassion for these poor sick children and for their families not to receive a bill is critically important. You need to take care of your child and not worry about the financial situation. That's what St. Jude does. And the only reason they can do it because the three of you gentlemen are down here helping me and helping the rest of us, make sure that that is the case and the outcome for these unfortunate children.
We love you. We love your team. We relish our relationship, and we look forward to many more years together. Thank you, Terry.
Guy, Dan, and Danny, I can't thank you enough. I appreciate you. I think the world of all three of you, and thanks for all you're doing.
Thanks, Terry.